Hello there. Welcome to Cost and Management Accounting N6. Today we want to look at a question from a past exam paper from June 2023. This is question 5. We are going to look at question 5. So we are going to start on 5.1, and 5.1 reads, the following information was extracted from the records of Star Store at the end of the financial year, 3rd April 2020. And then we are given a table of values there. And then we are told to, on the required part, to calculate the following. So the first one here is asking us to calculate marginal income per unit. It's asking us to calculate marginal income per unit. So first of all, we need to find the marginal income. We need to find the marginal income. Then we divide by the number of units that we are given, that is 5,000. Then we can get now the marginal income per unit. Right, so to find the marginal income, the formula is that we say sales, and then we subtract the total variable cost. So this is the formula that we have on the calculating of marginal income. So we are going to start with sales. So we see we have got many values there. Our sales figure is 300,000. Then our total direct material costs 45,000. And also you have to take note that all the direct materials are also variable costs, but the indirect ones are the ones that are fixed. But these ones are variable. So direct material costs, direct labor costs, variable. Then also have a total variable selling and administration costs, also variable. Then on factor overheads, we have factor overheads and brackets is 50% fixed. So what does it mean? We have a total of 90,000 there. This 50% fixed in brackets mean that the 50% of 90,000 is fixed, and the other half is what is variable. So let's just go there. It's the table that we have, so that our sales figure is 300,000. So if we go there, we have this table that we want to fill in and calculate the marginal income. We are seeing that our sales, we have 300,000. 300,000. Then from there, we want to calculate. We say we are now calculating total variable costs. Total variable costs. But for this variable cost, we have got a main component of variable cost. We have got from the table that from the question, we have got direct materials, direct labor. Right. So if you go back there to our question, we see those items that are there. For direct materials, we are here. We have 45,000. For direct labor, 30,800. So those are the figures that we want to enter in that table. 45,000 and 3,800. So here we have got 45,000. Then we have got 3,800. Then the next one, let's check the next variable cost that we have. We have got total variable selling and administration costs, which is 29,200. Total variable selling and administration. So we have total variable selling and administration. That figure that we are given there is 29,200. Right, that's the figure that we have. And also we have the last item that is there, that is being said it's 50% fixed, 50% variable. If you come here, we will factor overheads. Factor overheads is being said is 50% fixed, and its total is what is 90,000. So it means the other 50% is variable. So when we say 50% is 0.5, if you multiply it by 90,000, you will get 45,000. So it means this 45,000, we are allocating it to variable. So here we say factor overheads vector overheads. Vector overheads 45,000. Right. Having listed that, we can see that this is the last item that we have. Let's check to our table in the question. This is the last item that we have. The next one is fixed. If you come here, we now have fixed selling, and we are not looking for fixed. You only need variable. So we will leave that one and add the total for variable. So if you add 45,000 plus 30,800 plus 29,200 plus 45,000, you get 150,000. So that's the total that we put here, 150,000. So having done that, I think here we can just do this. Then right. So this 100,000, we are saying sales minus total variable costs. So we are subtracting here, and the figure that we are, when we say 300 minus 150, we get 150,000 here. And the figure that we found there, we call it marginal income. So that's the figure that we wanted to calculate. And our question, if we go back to our question is saying calculate marginal income per unit. Calculate marginal income per unit. If you come here, the question is saying marginal income per unit, and you know we've got 5,000 units. So per unit now we are now just going to say 5,000 into the total for marginal income. So marginal income per unit. Marginal income per unit is equal to 150,000. Then we divide by 5,000 units. So if you do that, what do we get there? Right. If you say 150,000 divided by 5, you are going to get 20 rands. You are going to get 30 rands, sorry, 30 rands. So it's going to be 30 rands per unit. So this is the marginal income per unit. Then we go to the next question. The next question is saying break-even quantity. Break-even quantity. Break-even quantity. And we know to find our break-even quantity, we say the formula for break-even quantity, we say fixed cost over selling price minus variable selling price minus variable cost. That's the formula that we use to find the break-even quantity. So our variable, let's check there for our variable and our fixed costs. Are we given those ones? Right. So our fixed cost is the one that we want to find, because our selling price minus our variable cost per unit, we have calculated it and we found 30. We have calculated it here and we found 30 rands per unit. So this is our 30 rands. This denominator, we already have it as 30 rands. So we want now to find the fixed cost. If you come here, our fixed costs are here. We've got fixed selling and administration, which is 30,000. So we have 30,000 here. We have 30,000 is our numerator there. So it means we have our 30,000 for our fixed costs is our numerator, 30,000. Then we add this 50% was said to be fixed, or out of 90, so it's 45,000 again here. That is fixed. Then we say over the selling price minus variable, which we found is 30 rands per unit, so it's over 30. So if you do that, 30,000 plus 45,000, and then we divide by 30, you are supposed to get 2,500 units. So this is the answer there. So we try to see the next question. So our break-even quantity is 2,500. Then the break-even value now, for the break-even value, we also want to see the formula for the break-even value. Right, break-even value, we say break-even value, break-even value, we then multiply break-even quantity, which is 2,500. Break-even quantity is 2,500 times the selling price. The selling price that we have is, let's check the selling price per unit that we have. The selling price per unit, we given the selling price per unit in the question. Let's check that. We are not given the selling price per unit. We are just given the total for selling price, which is 300,000. So this is our selling price, 300,000. Then we divide it by the number of units that are there to get the selling price per unit. So we are going to say 5,000 into 300,000. 5,000 into 300,000. So the selling price per unit is 300,000 divided by 5,000. So if you do that, if you say 300,000 divided by 5,000, you are supposed to get 60 there. So we are now saying 2,500 times 60. Because here, if we divide here, you get 60. So 2,500 times 60. So if you multiply it correctly, you're supposed to get 150,000. So this is our break-even value. Then we go to the next one. Let's check the next question. Right, from break-even value, you've got the safety margin as a percentage. Safety margin as a percentage. So the safety margin on its own can also come up with a formula for the safety margin. So safety margin, we can say safety margin safety margin, we can say it's the break-even value. Sorry, is the sales value minus break-even value. Then we get the safety. So the safety, we are saying how much did we sell above the break-even point? That's the safety margin. Then it is to be presented in the form of a percentage. So it means the answer that we are going to get there, we say over sales, then we multiply by 100 over 1. So that's the formula that we have. So if you go to our question, we find that our sales, is 300,000. Then our break-even value, our sales are here, 300,000. Then we subtract our break-even value that we have calculated there is 150. Is 150. Right. So here now we say sales. The sales figure is 300,000. Then we subtract the break-even value, which is 150,000. Then we say over sales, which are 300,000. Then we multiply by 100 over 1 to get the percentage. So let's calculate that. So if you calculate that, you are supposed to get, because here when you subtract the two, you get 150 again here, 150,000. Then you say over 300,000 times 100 over 1. Then obviously you are going to get 250%. So that's our percentage. That is our percentage. Then the last one, let's look at the last question. The last question that we have there. If you go there, last question is saying recalculate the break-even quantity if fixed costs were to increase to 90,000. So what is changing there is only the numerator. Fixed costs are now 90,000. So you're saying, remember we said this, the formula we say fixed costs for break-even quantity over contribution, which is selling price minus variable cost per unit. Then our fixed cost, we'll just say selling price minus variable cost, and this is not changing. We found it as what? As 30 that time. So our denominator is not changing. What is changing is our numerator. It's now 90,000. Then we divide by 30. Then if you do that, you get 3,000. So 3,000 units is the new break-even point. Right? Enough on the first part. Let's go to the second part. The second part is saying the following was extracted from the records of Solely Limited at the end of financial year, May 2022. Then we are given the figures there, direct labor, direct material, down to number of units sold. So let's look at the question. The question is saying prepare the income statement according to the absorption costing. So on absorption costing, the only specification on there that is there on absorption costing is that it takes into account all costs. Takes into account all costs. So you're going to notice that all the costs that are there, we're going to take them into account. We have got direct costs. We are going to take them all into account. Fixed and variable, we take them all into account when we are calculating the when we are preparing that income statement using absorption costing. So let's go and try to prepare that one. Let's go and try to prepare that one. So we are going to present a table. We are going to present a table. Right. Then we are going to, this is the income statement that we want to prepare. Income statement. That is what the question is asking us to prepare. Right. On the income statement, obviously, we are going to start with sales. But if you go and check in the question, you check in the question, there the sales are mentioned here. We put 1,800 units at 1,200 per unit. So to get the total sales, we are now going to say 1,800 times 1,200, 1,200 per unit. Was that is the number of units and the value per unit. So we're going to say 1,800 here in brackets. We've got 1,800. Then we multiply by 1,200. 1,200. 1,200. So if you do it correctly there, if you multiply correctly, you're supposed to get 2,160,000. Right. Then from there, we are going to list all the production costs that are there in the question. Less production costs. Remember, it's absorption. We are taking all the costs into account. We go there. If you come here, we start with the direct labor, which is 195. So we have direct labor. Sorry, we are supposed to create another column there to put the production cost there. So this one will obviously come. So that 2,160,000, we put it in this column. 2,160,000. Then we have got production cost. Then we have got direct labor. When you put it in this column, for direct labor, direct labor is here. We said 195. Then direct material again 108. Direct labor 195. Then direct labor here 195. Then we've got direct material. Direct material is 180. Like that. Right. Then beneath that, we also look for let's also look for the next cost that we have there. After direct material, we've got variable manufacturing overheads. So we're going to put that one again, and this amount is 95,000. Variable manufacturing overheads. Variable manufacturing overheads. So, all right, that amount of variable manufacturing overheads is 95,000. So, gonna continue here. Right. From there, we also look for another expense. After variable manufacturing overheads, we have the fixed manufacturing overheads. We have the fixed manufacturing overheads. We are also going to include that one, and that fixed manufacturing overheads is 85,000. Fixed manufacturing overheads here. Fixed manufacturing overheads. And then we found it there is 85,000. Right. We have now exhausted the cost that we have. Let's check if we have got another one. If you look there, we have now exhausted all the production, because here we're only listing the production cost. Administration cost is not a production cost. Selling cost is not a production cost. These are costs on selling goods, and this is administration, it's not production. So we've exhausted all the production costs. We can now add to get the total. So if you add 195 plus 180 plus 95 plus 85, you get 555,000. So you put here, because the production cost is here, so 555 will come here. Because this is production cost, and we are saying less, which means we are subtracting. So we are subtracting here, it's less. So we are subtracting. So if you subtract there, if we subtract there, then we get the figure for gross profit. So here, gross profit. So we are going to say, if we check there on top there, we are going to say 2,160,000 minus 555,000. So here, if you subtract this one minus this one, 2,160,000 minus 555, 555,000, you get 1,605,000. 1,605,000. Then we continue with our lines, because we still have administration costs, selling and administration costs. So you're going to subtract those ones here, less selling and administration costs. Less selling and administration costs. So those are the ones that we want to put there. Right. What are selling and administration costs? Let's start by selling. Let's start by selling costs. So these ones we are going to get them in the question. If you come back to the question there, if you come back to the question, let's go back and check the figure for selling. Right. Our gross profit is 1,605,000. Then we now want to check the figure for. Right. Our selling costs are here. We have got 70,000, and then administration costs we've got 60,000. So those are the ones that we are going to put there. Selling costs. Selling costs, we have got 70,000, so we are going to put them here. 70,000. Then we have administration. Administration. Right. So these are the costs that are remaining. So we have for selling, we have 70,000 here. Then for administration, we have 60,000. So if you add the two, you get 130. So this selling and administration is here, so we put here 130. Then we are subtracting, we said less, so we are subtracting, we put in brackets. And then if you say 1,605 minus 130, you get 1,475. So the figure that you get there is the net profit. So this is the net profit. So this is our final answer for net profit, 1,475,000. So that's what we have on question 5 from the June 2023 question paper. Thanks, guys, for listening. Keep in touch. Those who haven't subscribed, please subscribe for more videos. We are still in touch. Still, we write our exams. Thank you for listening. With that, I'm out.